Whether you are a taxpayer or the agent of a taxpayer, as we approach the end of January, we need to make sure we have considered whether everything that we need to complete a tax return is with the correct person who is filling in the form. Obviously things like bank interest, dividend income are things that we tend to pick up each year, but there are other things each year that often get missed off, and one of those is child benefit. You include on the higher earners tax return a tick in the box to say, actually I received this, we received this much, I'm now paying that back to you, unless you have said stop sending it to us.
You would say, are you claiming the child benefit? And almost as a courtesy really, point out that if the other half has higher income than you do, then they may well have to repay that.
So if you were a UK taxpayer receiving a letter from your advisor, we would expect to see a question about child benefit and the questions we've just discussed. Obviously, I mentioned in the introduction there, dividends, bank interest, things like that, but also pensions. We would need to know about pensions and payments into pensions. Also, potentially other benefits as well, which are taxable in certain situations. Whilst talking about pensioners, we should talk about married couples allowance. A lot of focus on married couples transfer ahead of next year in the introduction of that. But of course, married couples allowance still there for older clients. And we need to remember that the date of birth of the spouse could result in a receipt of married couples allowance.
That's right, and you could have a couple where one of them is the taxpayer, if you like, and the other one hasn't done self-assessment returns, and it is a married couple, they've got to be married or registered civil partners. Well, the rules are if one of them was born before 6 April 1935, then they are entitled to the married couples allowance and can decide which of them is going to claim it. And clearly, well, again, let's take a classic example, Darby and Joan. And Darby, in fact, is maybe 5 or 10 years younger than Joan. She has reached the relevant, well, she's not reached, she was born before 6 April 35. Well, he can then claim the married couples allowance. And it is worth pointing out that the MCA, although initially income related, in as much as if your income is over the threshold of, I forget what it is now, 27,000 or so, it's reduced on a 1 for £2 basis. Actually, there's a minimum figure, which for this year is 3,140, I think. It's given at 10%, so the value of it is £314, and it doesn't matter whether you've got a multi-million pound income, that does need to be taken and claimed wherever possible.
So again, information that you might not think obviously needs to be submitted as part of the, here's everything you need for my self-assessment tax return. Actually, that is an important one. Two others I wanted to pick up on. One is gift aid, and we must always remember that gift aid is something that needs to be included on tax returns. We can claim back 20% if we're a higher rate taxpayer. The other one though is PPI, and I wanted to mention the fact that I often refer to this as being a middle class hobby at the moment, is to see if you can get your PPI back. And if you do get it back, you will also get interest at 8%, I think. And that interest is taxable. And the big problem, of course, is that many people don't actually get a check. It gets set against their mortgage account. Other people will receive the check and forget all about it.
The compensation payments have been a bit of an issue over recent years. One of the earlier ones was equitable life compensation, and there the revenue specifically agreed that there was no tax charge, largely because the amount of compensation was a fraction, just over a fifth, of what you were really entitled to if you took into account what you'd lost plus interest, but because you only got a fraction of that, none of it was taxable. We've then got, as you say, PPI, and any recipient of PPI compensation should have received a statement from the person paying the compensation, and that would show how much of it is taxable, and that's what should then go on the tax return. And indeed they should have deducted tax on it, but for higher rate taxpayers there'll be a further charge. CPPs, another one, card protection policies, and again the interest element should be disclosed and is taxable. And there'd been other ones for the latest big one will be the interest rate swap one. So in any of these where there is an interest element, it's going to be taxable unless the revenue have agreed otherwise.
So when you are preparing the various bits and pieces to be sent in to the advisor, make sure that you have considered all of the things, whether it be the obvious ones, the dividends, the bank interest, but the less obvious as well, PPI perhaps, gift aid, child benefit information. If you're uncertain, send it in, I think is probably the advice we would offer.